Good evening, everybody. All right. Today we've got the great pleasure of having Andrew Gianavazzi. I've screwed that up a little bit. He's well experienced in option trading, so he's got some very interesting techniques how he has successfully traded options. So with that, Andrew, welcome to the Candlestick Forum. We're anxious to see the information.
Thank you, Stephen. I'm Andrew. I was Andrew Giovanazzi. I'm the Chief Operating Officer of OptionPit.com. I work with Mark Sebastian, well, on a daily basis. I was an option market maker, a member of the SIBO and the PSC for 16 years. And I have since come to OptionPit to help Mark. Basically, what we try to do is take all of the techniques we used as market makers, basically how to survive, and transform them into techniques for retail traders. So now that I'm not a floor member anymore, you got to figure out a way to survive. And this is a riff on what we do to get through different kind of markets. So the slide deck basically is called Creating Income with Options. How long is this webinar? It's going to be about an hour and 15 minutes. Okay, and I believe it's recorded and it'll be available from Stephen at some point, probably with the slide deck. No problem. Alrighty, so let's get right into it. There's handsome Mark Sebastian. He is not here today, but there he is on Fox News talking up Liz Claman. A lot of Twitter action about that whole relationship. I'm not quite sure. But anyway, Mark talking stop-loss orders with Liz on Fox Business News. What are we going to learn today? Number one is, as an option trader, you're basically running your own insurance company. Mark wrote a book about options in general and how to manage the risk of short premium. So what we're going to do is talk about the structure of how you sell options to create income. Right? Nobody ever talks about buying options to create income because I think it's a little antithetical. But this presentation is going to focus specifically on selling options, right? Basically in a hedged manner. And what are the ways that make that interesting for us as traders? And speaking specifically as an old floor trader who needed some of these techniques, and we'll be talking about these. So the first thing is basically how insurance companies make money, okay? Because options basically are an insurance business. How do options relate to the insurance business? So when you structure how you want to manage a book of options or even a few trades, you kind of want to think like an insurance company. How you identify under or overpriced options. Is anybody talking? I believe so, unless there's a problem with the sound, Mike L., you might have trouble with it. Okay? Cool. All right. Next, how to generate a position selection routine. So thank you guys for chiming in there and helping out. Some people have no sound. I think you're going to have to deal with that, Mike. You're the only one. Okay? So the important thing here is structure, pricing, routine. Okay? Conditions of volatility that produce optimal conditions. All professional traders that trade options basically are vol traders. Okay, and we're going to walk through these steps. Also at the end, we're going to example of a trade and how it fits a market condition right now. Basically just something we've traded in OptionPit. Spread that has worked pretty well in a particular stock because it fits a particular thing. And after we walk through the methodology, we'll walk through the trade. Okay? And hopefully you have something to take away here after your hour and 15 minutes. Okay? So number one, insurance policies make money selling insurance policies to lots of individuals. Okay? The idea being that only a small fraction of people redeem at any one time. Right? and it leaves insurance companies with excess capital to invest, right? So what they're trying to do is they're trying to spread risk over a large area, essentially. Well, one of the key things, right, is insurance companies try to sell things that they think are too expensive, right? And they reduce risk by going back to the insurance market and going to the reinsurance market, right? So not only do insurance companies try to sell things that are too expensive, but they're also trying to hedge what they have. Okay? So, Mark basically wrote a book about this, The One-Man Insurance Company, with a money manager, Dennis Chen. Okay, so it's about 200 pages, and it's the idea of how to structure an entire book of options. Hello, everybody. Okay. Now, so let's just start to compare some things, right? Insurance policies collect dollars up front for obligations to pay claims later. Meaning, what? They're taking in dollars now for an obligation later, which sounds kind of familiar. Okay? The same thing is, when you sell options ahead of time, they generate a credit up front for basically giving an obligation away at some time in the future. So selling options and writing insurance policies are very similar. So when you sell calls or when you sell puts, you need to remember that. Okay? You're in the insurance writing business. So if you want to collect income from selling options, you have to figure out a way to manage the business. Okay? So now let's look at a couple. Right? You look at the top line. Underwriting, pricing, reinsurance, claims, customer acquisition, investment operations, right? Just this is how an insurance company works. Okay? Now let's take that and change it around a little bit for the market that we're interested in. Trade selection. What do I want to do? Risk management. How do I control my risk? Trade execution. Okay? How do I put something on? Right? 3 pieces. Andrew, can I move my cursor off to the side? I can. Okay? So, all you're doing is adapting an option trading, okay, to an insurance model. Okay? And the idea is, how do I take these ideas and try to manage risk? If I want to find something to do, how do you manage risk? Okay, oopsie, I did it again. Now, let's start to look at some of these things. Right? Trade selection. What market am I going to trade in? What products? Pricing. Right? What pricing is interesting to me? Strategy selection. Condors, butterflies, short gamma, long gamma. It's a huge list. Right? Time frame. Right? Generally with time frame, we want enough time to make sure that our idea or whatever we're doing works out. Right? The problem with options, if you trade stock, stock basically has a very long lifespan. Options do not. Right? So you have to be right within a certain period of time. Well, Don says low pricing, high return. One would hope. Right? That's called leverage. So risk management part is position sizing, which we'll call positing sizing, but it's position sizing. Managing money, being able to adjust trades. As basically, if something's going against you when you're short premium, is there anything you can do to try to adjust or fix some of the risk? Okay, buying options against a short position, right? That's the reinsurance part. Right? Disciplined closing of positions. I made some money. I'm going to close the trade. Right? Just like when you trade stock, if you buy some stock and it rips, you need to sell it. Okay? If you sell stock and it falls, you need to buy it back. Options are the same way. There is a certain amount, because options decay, you're thinking, wow, if I could just hold on to this for a couple more days, everything will be great. But you got to close positions. Last, portfolio diversification, meaning what are the types of trades do I have on? Am I all totally weighted in biotech? Am I all just big cap technology? Maybe trying to spread some things around. I have some index positions. I have some volatility positions. Something to get some of the risk out of one particular place or concentrate in one strategy. You want to keep things moved around. All right. Last, executing, right? Where do you send an order? What strikes do you pick? What terms do you pick? Right? A complex versus an individual order, meaning complex order like 3 legs. Individual orders, I want to buy 10 or sell 10. Right? I want to buy a spread, sell a spread. So the idea is when you hit the option market, a lot of the decisions you have to make have a parallel decision-making process with insurance. Okay? And just like insurance, there are times when you want to write insurance or be an insurer, and there are times you don't. So we want to figure out when those times are. Okay? When really do you have a good shot at selling options and making some kind of return on it? Okay? What that leads us to is a process. We have a trade selection process. We have a risk management process. We have a trade execution process. A trading plan, as in, how am I going to deal with this trade from open to close? If you think about trading any type of option, investing in anything, you have an entry point and you have an exit point. The thing with options is because they're finite, you need to think about an exit point. And a lot of times, that will help you decide whether it was worth doing in the first place. Okay, trading infrastructure, as in what kind of support do you have for the management of a position? Can I see the Greeks? Can I understand how the trade's actually going to work? Is my platform going to work? Is it in real time? All that kind of stuff. And last, some sort of learning process, right? Option Pit is basically devoted to option education. But you have to learn how options work. If you don't, you could have a nasty surprise, right? And a lot of option trading is education. Just trying to figure out how that option is going to act. Okay. So let's start, right? So looking at markets and what markets to trade, how do you tell if an option is fairly priced? Okay. So the first thing, remember, is insurance brokers sell overpriced options. Okay, that's the important part. If they sold stuff at value or below value, they wouldn't make any money. IV versus realized vol. Yep. So most of the option model inputs are known at the time of execution. So remember, right, options are priced. A lot of the inputs are known, but not all the inputs are known. Okay, so an insurance company will just use an actuarial table. If you're 80 years old, you're a smoker, right? You might be overweight, underweight, whatever. They're going to nail a percentage where, you know, they'll pick a year where you're going to die and it's going to be relatively accurate based on their data. Okay, option traders use Black-Scholes or some variation of Black-Scholes. There's all kinds. But the important thing to remember once when you're trading with any kind of options, kind of stick to the model that you started with, especially when you put on a trade. The second part is what goes into it. Okay, cost of carry, meaning the current interest rate and dividends stream of the particular name, the stock price, underlying price of the name, whatever the strike is, the time to expiration, and the forward volatility. Most of those are known at entry. Okay? Cost of carry known, strike is known, stock price is known at entry. SV stands for, I think, realized vol. LDJ3. So that's basically the volatility of the underlying, whatever the underlying happens to be. Time to expiration is known. Forward vol is not known. Statistical vol. Statistical vol, historical vol, realized vol, they're all kind of euphemisms for each other. So statistical vol is not forward vol, though. Right? So one thing everybody or most people think about the option model is it's putting in the current, let's say, implied volatility where the options are trading. The big difference is Black-Scholes requires the forward vol, the volatility between now and expiration on an annualized basis, which nobody knows. What that means is there is a lot of room. It's not the implied vol, right? The implied vol is just a forecast, MB. Implied vol is where the market says options are trading right now. The forward vol is saying where options should be trading in 3 months. Right, so that's the thing with Black-Scholes. Black-Scholes wants a known number for volatility, the forward vol, but we don't have one. So implied volatility is substituted as a guess, which is how every vol platform runs. Any option platform you're running to get a theoretical value for the option is using the implied vol. Okay. Now let's introduce you to a vol chart. You know, I think you guys look at all kinds of charts here already, so it's not the first chart you've looked at. So here there's just basically 2 lines. I think Doug said statistical vol and he said implied vol. Red line, 30-day vol. Oh, Diane, I love this one. Dion, implied vol follows historical vol. The only thing I will say to that is sometimes. Sometimes. Okay. One thing you can see is if you look at this red line, let's look at the very far, let's say if I move my cursor over, right? Can I see my cursor in here? There it is. Okay. If I look at the volatility here, right, Dion? Remember, this is a 30-day forward-looking number for volatility. If you go 30 days forward, was it right? Okay. No. So is the IV for option and the SV for the underlying? That is correct. So what you have here is you have this blue line is the 20-day backward-looking volatility. So what this is showing you, when we were right here at this point, the average volatility for the last 20 days was 3680. Okay. The implied volatility here, looking forward, was right around 40%. So the market was pricing a pretty big move for implied vol that the realized vol did not deliver. Okay, so the idea is there's a discrepancy between the two. Right? You've got what was I think you guys were just talking about was a statistical vol or realized vol that looks backwards and implied vol that looks forward. MB says, the option industry overpricing. Well, you know, there's a lot of books written about iron condors, right? There's a reason. Because puts are expensive. Okay, they charge more money for them. But this is sort of the mathematical basis for why those are expensive. Okay? If the stock is really not moving enough, what happens is that option premium tends to contract. Stocks are moving a lot, the option premium tends to stay more, you know, kind of robust. So here, what you're trying to do when you're looking at forward vol is, and this is kind of a test, you know, that I do when I'm looking at an option trade is, will the next 30 days be as volatile as the last 30 days? So if I'm looking to sell 30-day premium or 60-day premium, I ask myself, is the next 30 days going to be as volatile as the last 30 days? And what you get is you can decide, and this is on an earnings cycle, right? And earnings cycles are unique because options have a hard time pricing one-day events. They don't do very well. So when you look at this chart, you're just trying to figure out, all right, well, the volatility is kind of high and the realized volatility is sort of low. Why? Is there a trade there? Is there something there for me that might be interesting, or is there a surprise sort of lurking over the horizon? Okay, but the important thing is trying to get a sense of where the market is pricing volatility, which is implied, and how the underlying is actually moving, which is our little blue line here. This example here is 20-day vol. Okay, so a couple of things to think about. Your at-the-money implied vol is the market's best guess for forward vol between now and expiration. Okay, and you're going to ask, where, Andrew, how do you know that, and all that kind of stuff. After trading options for long enough, you want to go to the liquid contract, where there's the most buyers and sellers expressing the most opinion. It tends to be at the money. So the implied vol is the market, what we'll say, best guess for forward vol. Doesn't mean it's right, but that's the best guess. Okay. Now if you look at it, what we'll say just with fresh eyes, the red line should be right. It should lead the blue line. Okay. But does it? Okay. Implied volatility here was peaking, but was it really giving you a look on where the realized vol was supposed to be? Okay. And for the most part, implied volatility misses the mark a lot. An awful lot. For the most part, the options were priced too high most of the time. Okay, average IV is about 30%, and options seem to price much higher than that. Is it the market makers? All market makers do is try to create equilibrium. So when I was a market maker, I just wanted to find a volatility that I could clear the market, basically where I could get kind of match buyers and sellers. Sometimes that's a higher number, sometimes that's a lower number. But that's what liquidity providers try to do, or rip faces off retailers. It's not a bunch of guys in a room saying we're going to rip off this retail face, right? Although I like it. I like the concept that you're thinking. It doesn't work exactly like that, right? Because all they're trying to do is balance buy and sell paper. Wow, there's a lot of buyers, we're taking the vol up. Wow, there's a ton of sellers, we're going to take the vol down. So as a retail trader, what's the one thing that you get to control? Kind of like an insurance company, right? You get to control when you sell an option. An insurance company gets to control who they sell insurance to. You can be picky. Okay? So, looking at the realized vol and implied vol, is there some sort of trend with the options? Just like vol can trend, or stocks can trend, right? You've got an upswing like Facebook. We'll talk about Facebook as just made a new high. I think a 52-week high, an all-time high today. Right? Oil, not a really great trend, looking kind of ugly, right? Those are trends. Vol trends much the same way. And the more you look at volatility actually trends fairly sharply when it picks a direction. Okay, which is important. So 30% IV for both calls and puts, or each different? Carl B, the answer to that is generally volatility, call or put on the same strike should be the same unless something's going on with the stock, like it's a hard to borrow, or there's some sort of special situation which drives the volatilities apart. Some stocks can't be borrowed as short. So you're going to have a vol discrepancy in call and put. Right? So the idea you're trying to figure out is the policy too expensive or too cheap, and what I would say is relative to a trend. So if you want to sell vol, if you want to sell options, do you want to sell the volatility into sort of an increasing vol market, or do you want to sell it into a declining volatility market? It's like anything else. When you want to sell a stock, what do you want the stock to do? I want it to go down. So if you sell volatility, which I call just selling juice, right? You want to sell it into a declining market. Right? Selling option premium in a rising vol market is like catching a knife the other way. It's like trying to pick a bottom with a stock, right? So I prefer when I see some kind of vol trend one way or the other, if I'm really going to come up with some sort of income producing play. When I sell a stock, I want it to be going up. So that way when you sell it, it goes back down. So volatility, though, definitely trends. Ideally, you're selling Vega, right? Well, you can get a better price for what you sell, right? But the problem with implied volatility is I just sold volatility when it was 40. Now it's 50. Now it's 55. Now it's 60. Right? What do you do? Right? Because volatility, just like I showed you in the chart, it tends to trend. Trading volatility might be a little different than trading stocks. We definitely mean selling an option here, not the stock, without question. Okay, remember, we're looking at ways to generate income by selling options. So what do we mean by a policy, right? If you sell a put, what are you selling? Right? You're selling protection at a strike. Exactly, you're selling stock insurance. That's a good way to put it, John D. Just like you sell a call, right? You're guaranteeing delivery at a price. What are they paying you for the risk you have to incur to sell a call? At Option Pit, we don't sell naked calls. We sell call spreads because I don't like dealing with risk that has no limit. Okay, I deal in spreads most always. So what you want to do is thinking about what the current level of realized vol is. So does it trend like within trend lines or like, BB when you mean Bollinger Bands? Well, I'll take an idea. I guess I'll give you an idea of, the idea is, let's just look at VIX this week, right? You're going into an event. That was the FOMC meeting. We had slightly elevated vol. As soon as the event came, vol started coming down. Right? It got a little shock up today. Right? But we'll probably see, if nothing really happens, we'll see vol come in a little more. John A., I think the sound is okay unless people start lighting up my room here. You might have to log in and log out. So the idea is you want to make sure you interpret your realized vol the right way. Okay? And what I like, again, like I like saying is, will the last 30 days be as volatile as the previous 30 days? Okay? It's the easiest way I can think of. Well, in the last 30, oh my gosh, that's such a typo, I can't even see straight. Thank you. It should be the next 30 days. Tawfiq, you're right. Hold on. Can I fix this? I almost want to fix it right here because that's such a egregious one. Hold on. Ay, ay, ay. Okay. Hopefully I didn't just blow the whole thing, but I think we're okay. We still operating? It'll be there in a second. There we go. So, don't you get more premium credit if volatility is up, sell? Okay. Richard B says, don't you get more premium? You do get more premium, right? But when you sell higher vol, it comes with a price, and the price generally is more realized vol. Will the last 30 days be as volatile as the next 30 days? Nope, I did it right. Will the last 30 days, oh geez. Sorry. There we go. This is Grammar 101. All right. There we go. Sorry, guys. You would be surprised how difficult it is with this grammar sometimes. My gosh, it can be difficult. So what the idea is, again, you're looking at realized vol the right way, and you're looking at a data set for large outliers. Meaning what? Right? Is, I know, you guys are doing a great job paying attention. I'm a trader, not an English teacher. Okay? The way I want to look at, you want to sell vol when the realized vol is dropping. Okay? To me, that's the number one thing. Okay? You don't want to sell implied volatility when it's cheap. What you're really looking for is when is the realized vol going to drop? Okay? So what I'm looking for is when is realized vol dropping? Okay? As long as you don't sell the call when you mean to sell a put. That's called a fat finger. In Maine, we call that a lobster claw. So I've got 10-day implied volatility, right? That's the white line. I've got 20-day volatility. That's the blue line. I've got 30-day vol. That's that little kind of nice-looking violet line. Can you scan for premium and overpriced premium in stocks? You can to some degree. Okay. The thing though, Gregory, if it's just a scan, it's relatively easy, I think. Right? Because if you could just scan and say, okay, that premium is expensive and I'm just going to sell it. Doesn't that sound too easy? What do you do when an IV does a crazy Ivan? It depends the product on. So generally what I do, I'm just, this is being recorded. When IV goes insane, I tend to buy gamma neutral trades, meaning I'll just buy straddles in the SPX and I'll hedge with VIX. I'll buy a lot of VIX puts or VXX puts or something like that and keep the gamma. Slightly different than what we're talking about here. Right? What we're talking about here specifically is a condition that makes selling options viable. Okay? If you sell options into increasing realized vol, you have a very hard time of being successful. I don't care what anybody tells you. Right? In this particular case, I've got, notice how in the SPX in this particular slide, right, the 10-day volatility is falling off the face of the earth. Right? That's the white line. Right? The next thing, 20-day, 30-day is starting to catch up. All right. So don't you pay attention to open interest as well? Sort of. That's another conversation, Robert. Open interest helps with you trying to kind of get in and out of an option. If there's volume there, a liquidity provider would be more willing to trade somewhere closer to the middle of the market if they want to unwind something. Okay, but you generate open interest just by making a transaction. What you're really interested in is the issue liquid. Right? If the markets are $2 wide, you're going to have a hard time doing anything. Okay? Again, this is strictly looking at realized vol. Is the realized vol declining, or is it going to blow up after you sell something? So you're calling statistical vol realized vol. That is correct. Yep. So when selling options that expire in a week or two, isn't implied volatility less important? Well, I would say that, Mark, the vega is less important because implied volatility is less in dollar terms. When you're selling options basically that expire a week or two, you're picking a spot, a strike, and saying, am I going to get there or not? Right? Volatility, remember, the model fails short term. It actually works pretty well long term. Shaw says, is there any merit to trading options close to expiration? Shaw, that is a totally another subject. I have clients that do it very well, but they're pretty darn patient. Casey, statistical is realized is historic, yes. Basically, you're looking at underlying vol, statistical, realized, historical. It looks backwards. Right? What did the stock just do? Okay. Implied vol, what is the stock going to do? So that's why we put that line in there, right, that I finally corrected. Is the next 30 days going to be as volatile as the last 30 days? Mary D says, how do you use gamma? We'll talk about that in a second. That is a whole nother dozen webinars. But you use gamma basically to tell you how sensitive you are to an underlying move. So Mary, if you're selling options, do you want to have big gamma or little gamma? We're going to do it at the end, Nazine. Okay. Let's look at a couple things out here, and then we'll get to it. Don says, implied volatility does not really equal future volatility. That's exactly what we're saying. It's the volatility that the market is pricing right now. Okay? What I said earlier is implied volatility at the money is the market's current best guess for future vol. Best guess. So if I want to say, what does the market think is going to happen in the next 30 days, I go to the at the money. Okay? And from there, I look at realized vol and I decide, is the market overpricing or underpricing these options? And then I go look at what I want to do. Okay? Got it. It's okay. Now that everybody's paying attention, I'm going to keep rolling. So 10-day vol, right? Basically, the idea is you're trying to get what's just been happening with the underlying. Okay? You guys can throw the questions at the end. I just had so many questions. I can't believe everybody's awake and they're moving and they're typing. Okay? What just happened, 10-day vol? 20-day vol, basically the last month. What has been happening? Okay, remember, you're getting a feel. 10-day vol is touchy. 20-day vol, what's happened the last month? Okay, 30-day vol, less noisy. So when you're looking for, let's say, iron condors, all right, trades that you're working more out of the money, trying to sell options a little farther out, what's the 30-day vol been trading like? Again, giving you an idea. Okay? If the last 30-day vol was just 35 in the SPX, you're going to have a hard time selling iron condors and winning, right, if it stays there. So you need to have an opinion if it's going to stay at that level or not. 60-day vol, right? That's like kind of a long-term trend. Let's give you an idea. So if the 60-day vol is 40 and you're trying to sell 30% vol, you know you're selling something a little too cheap. Can it work out? Sure. But you know going in that the name has been relatively volatile. And unless something has changed drastically, that vol is going to be a not great sale. Okay. Last here, looking at a price chart to see if there's something not coming through realized vol. Sometimes, right, because remember, a lot of this volatility, or most of the vol we're talking about, realized vol, statistical vol, historical vol, is close to close. Is there an average true range in there that's doing all kinds of crazy stuff intraday? Right? How many days this year have you seen where the market goes nowhere but had a huge one-day move? Okay. Of course, somebody's asking me a question. I would say maybe. Okay. 10-day and 100-day is almost, they're like almost two separate monsters. Right? What's more important to think of is I have 10-day vol. What's 10-day implied vol trading for? I've got 100-day vol. What's 100-day realized implied volatility trading for? Right? Is that a tradable position? Okay. So, again, my opinion, Mark's opinion. Rising or falling realized vol is going to be the #1 determiner how your spread or strangle or condor is going to perform. Probably swing trade. 20-day is not bad, James. He's asking about swing trading, just to give you an idea. Okay. Definitely our opinion on this. Okay, but sell options and have the realized volatility explode and tell me how well you do. Okay. Unless you're 100% right on direction, you're not going to do very well. Okay. The second part is implied vol. Right? As a young trader, one of the partners that started my firm was like, you can pick the trade as long as I can pick the price. Right? So if the price is great enough, it's almost hard to mess it up because that allows you a lot more room. Because in general, just we had a question on gamma, the higher the implied volatility, the smaller the gamma is going to be. Right? It gives you a lot more room when you sell options. Okay? Now, implied vol. Right, so we'll go over some of these topics that we covered, so this will be a little quicker. How much the market is expecting the market to move over some period of time. Right? How much do we expect it to move? Okay. Again, expectation, guess. Implied volatility is just the sum of all the fear and greed of all the participants in that name. Okay. It means reverts over the long haul, meaning implied volatility doesn't stay super cheap forever, and it doesn't stay super expensive forever. Okay? Because it's connected to something else, right? It's implied vol ultimately is connected to the underlying volatility of the name. Okay? But if a fund wants to sell 20,000 calls, implied volatility is going down, which is why VIX goes up and down, correct? All right, so VIX has stayed at kind of a slightly elevated skew now for the last 2 or 3 months. It's starting to come down. Okay, but VIX is just a what? It's a reflection of basically put demand for the most part, although the calls count, but it's really put demand really drives it. Okay, sometimes people want the protection, sometimes they want to sell it. Okay, so you're just trying to figure out what's your advantageous pricing based on what you think is going to happen going forward. Okay. Durations. 30-day IV, what might happen soon, and 90-day IV is a longer-term trend. So basically, right, when the market's going through big swings, one of the biggest swings I remember of what we've had actually in the last 4 or 5 years is long-term vol has slowly been going down, since 2009. Okay, even since 2011, 12, when we had all the European stuff going on. Right? If you go back and look at vol charts, that longer-term vol was all much higher. How do we use the information to help us? We're going to get there right now, George. We're going to put a plan together, and it's going to make you happy. Okay? So, this is the market price for vol. We're going to call this fair value. Are you saying whales move vol? What I'm saying is realize vol expectation moves vol. Right? If you think the euro is going to fail, how do you price that? Okay? If you think the rate, right? That's a big problem. If you think the Fed's going to change interest rates, that could be a smaller problem, right? But they're both problems that are priced, right, on a vol expectation. Okay? So if we call basically where the implied vol is sort of the fair value for now, what's important is when the fair value changes. Okay? Oh, it's not that hard. All right, so let's look at a couple things. '30-day vol, red line. Green line, 90-day vol. Yellow line, which is kind of buried in there somewhere, is 60-day vol. Okay? So you notice a pattern between these, right? What's one thing you notice between the green line and the red line? Right, this is for the SPX. Longer term vol is almost always above the red line. Just like if you see a curve in the VIX or anything else like that, longer term vol is more expensive. Why? Nobody knows what's going to happen. 30 days, maybe you can figure out for volatility. 90 days, good luck. Okay, that's actually different than how it traded when I first started in the late 80s and early 90s. That longer term vol is actually cheaper. Weird, but changed. Now notice one thing that happens when that red line spikes. What's the one thing you notice happens? Right? Short-term vol and long-term vol start to trade at the same level. Okay, that's when the market's going under stress. You want to tell when the market's really freaking out? All the volatilities tend to trade at the same level. Okay, so for implied vol, the number one determinant of straddles, flies, debit spreads, anything you can think of, you're derived from IV. The second determiner is the realized vol. Basically, can you get enough of a price for what you're doing to make it work? And then how the market moves after that is going to determine whether these trades are going to work. Right. Remember, we're here talking about income generation and selling options. We're not talking about if the stock's going to go up or down. Okay, so now let's look. Here's a few things. Looking at term structure. Is your 30-day IV below the 90-day? We're going to call that normal. Sell on high vol. Generally, you want to sell on high vol, but you want to control the gamma, Richard. Right? That's position structuring that you can learn. Okay? Anytime you have your 30-day vol lower than your 90, we'll call that contango. That basically denotes a normal market. Right? Basically, that's the market saying, I don't know what's going to happen in the long term, but not much is happening right now. Okay, it's logical. Okay. So what you're looking at is the market tends to move into more logical patterns, like I don't know what's happening then, but I'm looking at things are going to calm down a little now. Are those charts looking into the future or are old charts of past history? Those are basically the implied vol charts right now, Carl. Okay, those were samples of just a couple of months ago. Well, the Facebook is today, though. Okay, backwardation what we'll call backwardation is when all of the short-term vol is way above the long-term vol. Meaning that there's so much movement right now, it's very hard to sell short-term options because the daily movement is just, it's large. We get the IV charts from live vol. Okay, these markets tend to be more reactionary, meaning selling short-term options is very hard to be successful. Okay, it's less likely to hold a trend. Would you do calendars then? We're going to talk about a calendar in a second, Greg. The problem with the calendar is I'm going to show you calendars don't like the market moving very much. Backwardation was the norm during the tech bubble. Yes, it was. Backwardation was the norm in the fiscal cliff, Euro crisis, everything else. Okay. Also, we have something using VIX and VX or VXV, which is a longer-term VIX. If you live all of the charts we use, but those are guys I traded with that started that company, so I like them. Their charts are pretty good. Their product is nice. Okay, so the idea is between contango and backwardation, right? So we're talking about vol moving. Right? You want to look at some current relationships. So here's something that might help, right? So if the VIX has been trading at 1 point under VXV, which is the midterm vol, for the last 90 days and moves to 2 points under, something has changed. So the idea being, if shorter term vol and midterm vol, that relationship starts to change apart. Why did they make option trading so hard? All this is just education on how volatility works, Casey, basically. If you're going to go out and sell options and you have no idea about how vol works, you're going to have a hard time. Okay. This gives you an idea of what the market's pricing. So basically, supply and demand kind of creates trade ideas. So the idea is, right now, short-term vol, the VIX is starting to drift lower, right? And that long-term vol is starting to get a little higher again relative. Okay. So the last thing here on term structure, right, as we wind to the end. If you're looking to sell premium or buy premium, right, it really moves vol around. So I'm a fund, I want to sell options. It's going to crush the vol. If I'm a fund, I want to buy options. It's going to raise the volatility. Arlene, if you can't hear, log in, log back out again. So if you want to trade calendars or time spreads, you want to look at the term structure. Okay, or even double diagonals, anything like that. Okay? Because they're euphemistically known, right, as income trades because they generate a credit. Okay, so if we look at Facebook recently, okay, it's just on a tear. Probably going to go higher. Who knows? All right. However, if we start to look at the realized vol a little bit, do you guys notice that the little turquoise line? Right. Shorter term volatility seems to be moving up, right? The longer term vol, though, is really low. So the longer term trends kind of hasn't been doing anything, but all of a sudden, it's ripping a little bit. So what that means to me is Facebook is moving. They might be getting nervous, but I like that. People getting nervous on a pullback on Facebook. So if you structure a trade, just write what Don said. If I'm structuring a trade and I want to sell options, don't you want to take into account the fact that some of these people are getting nervous? Okay, look at the implied vol. Now the 90 and 60 day, right? That's the vol up here. That's covering the earnings cycle. Okay. The red number is the 30-day vol. Notice how the implied volatility is about as low as it gets in Facebook. Dead cheap. Do you want to sell something at the bottom? Generally, no. I think it will be available on the internet. Dad Stephen will explain all that. Okay, so let's just put some things together that we just learned. So Ivy in the basement and SV rising. Wouldn't you rather buy some gamma, says John D. Let's see if you like this idea, right? Because buying some gamma means what? You're expecting it to what? Move in one direction or the other, right? It's going to continue its rally, or people are nervous and it's going to pull back, right? So you structure that. You've got bouncing to 83. Realized vol is low. It's a little flat, but it's actually starting. The longer term vol is coming up, right? Your IV is really low. And the term structure for the options is relatively flat. Now, I forgot one slide here, but some of the vol in April is basically trading at the same price. I have to pull my application up for that. Right, so what I did was, right, so you have basically lower IV, you have low realized vol, but it's increasing, meaning you're expecting kind of a move to a side, right, and a flat term structure. Okay, just want to make sure I got it. Okay, so this is the idea. Okay. So what fits? So the idea is you want to be, you've got implied volatility is low. I'd buy a vertical call spread and pay for it with a short put. You could do that, but you're just dead long, right? So the idea here is, but I like the idea. But in this particular case, since I want exposure to implied vol, it's low, I want to be long Vega, basically being long volatility somehow. I want to be short premium in general because realized vol is low. So at the very minimum, because it's moving, I want at least one easy move if it moves farther than I thought. Right? And because our term structure, at least from the vol, from the implied vol in April, right, before earnings is relatively flat, I'm looking for contango to set in kind of prior to earnings. Okay, so what I just came up with is a time spread, but it's an adjustable time spread. So I'm looking at the Facebook. I'm buying the April 2s, so that's the April 10 weekly, selling the March weekly next week for 65 cents. What it does is we're trading here. You have room for a pullback, but you also want the stock to keep floating up in a direction. Now, if Facebook does pull back a little bit, what I generally do is I'll take half of the position off and I'll buy a calendar spread, let's say like an 80 below it. And you basically create a double calendar. But at this point, because it has a trend, I sort of want to let it go. It can keep going up and let time build the theta in. If the market does what it's doing, we don't really go anywhere, then I'm okay. Okay, but one thing down here to note, notice the volatility of both of these options. Okay, the April 2 is 2080 and the March weekly is 2182. Would you only go, you go long only since you're bullish? If you're bullish and you want to buy a call just because the stock is cheap, that's fine. Okay. The thing is I want a trade that's going to pay me if it doesn't go anywhere. It looks like it's going up, but the whole idea of structuring a trade like this around vol is if you're right, great. It's going to work in your favor. Which week in March? It's next week's, the 27th. So the idea, right, if we think contango is the negative, exactly. If you think contango is the what will happen to Facebook vol, what's going to happen? Exactly. You're selling a slightly higher vol buying with the expectation that that vol will come in a little bit relative to my back month. You could do the same on the put side, but I would move the strike lower if you move down or higher if you went up. You could buy a call spread and finance it with a naked put. Okay? I will never tell you to sell a naked put. I do it, but I'm not going to tell you to do it. Mostly because I've had enough clients, like I sold a put and it blew up in my face. I thought you were going to talk about selling options. We are selling options, right? We're collecting theta, collecting decay, but we're trying to do it in a way that has less risk. Right? This whole idea of this is a risk-adjusted way to sell options. In Mark's book, he talks about units, but it isn't defined. How do you calculate your reinsurance? Generally for me, Don, units basically means I want to own a basket of index puts, which allows me to sell stuff everywhere else. Do you exit prior to expiration or you wait till you're shortly to expire? I'm looking for like Wednesday of next week, if all goes well. If I didn't have to adjust or mess around with anything. I mean, if everything's going great, you can hold on to it for as long as you can. So, Steven says, for Facebook, how about a double diagonal next week for the puts and calls as a result? The only thing I would say is I'm setting up the time spread so I can make an adjustment if it moves. My other thought was just a standard kind of double diagonal, like an 80-85 on it. So, Steve, your idea is right, but when you trade a double diagonal, you actually have more short gamma. Just letting you know. I'll show you. There's a cover of Dom's. When you guys asked for the slide deck, so the thing is, because there was a little bit of a pop in realized vol because it's kind of taken off, I didn't want the short gamma from a double diagonal. I want to be a little long. Hey, and you could sell a put spread against it. That's fine with me. Okay, to finance your call price. But in this case, I just want to make it simple, and then you kind of make, do I have a move? Okay, I can buy other call spreads if I need to. If it moves up, great, I'll make money. If it goes nowhere, I'll still be collecting some theta. Right? So I'm trying to show, right, a way just to look at what the vol is giving me right now. Is it a trade? I think it's a nice little trade. We've been long time spreads in our strategy letter in Facebook. We just closed a couple last week. It's been working pretty well overall. All right. But when the realized vol is kind of low, you get room. So if I'm buying a straddle, you want the SV on its way. You want the realized vol as high as it can be. There's no too high. Okay, that might be another subject for another time. It's hard to buy options. It is. I like doing it, but it's hard. All right. So, summary-wise, right, because we're about out of time. So insurance companies make more money by selling premium for more than it's worth. You kind of want to do the same thing. Okay, you want to try to find premium that is trading for a bit more than it's worth. Or like you use a spread to kind of ride the conditions that you see. Right? If I get the contango actually comes into Facebook, they'll drive the vol a little lower. Be great. Okay? So some of the things we look at. Underlying price, realized vol, statistical vol, right? Historical, all that stuff is HV. That's underlying movement versus implied. Lastly, term structure. Okay, how is the option pricing the difference in the months? Because you know when the market's under strain, it's going to go backward. It always does. When the market starts to relax, it starts to go into contango. So if you're jumping into a condition for a particular type of trade, an income-producing trade, you want to at least see what the market's giving you. Other than selling covered calls, what is the most basic method of generating income with options? Probably selling put spreads. James. After that, I would say iron condors or time spreads. Contango basically is when the front month vol is lower than the back month vol. Backwardation, so contango is sort of a normal quiet market, because look at when you think about it, if I go back, what's the vol expectation? Okay. The realized vol is, if the implied vol is so cheap, the expectation is not a lot's happening. If that near-term volatility is sky high, that means the market thinks we're moving anywhere and everywhere. All right? Okay? So take the information the market's giving you and at least think about it. Right? Might not change anything you do. Most pro guys that were on the floor that are now just basically prop trading are still trading volatility. There you go. Look at how handsome Mark is. Is contango like interest rates for the short-term rates are lower than the long? That's what contango would be. Yes, Bill. Yep. And think about it this way, Bill. When those near-term rates get really high and the short-term rates are low, the market's all freaked out, right? Doesn't like that. The market freaks out in backwardation. It's happy in contango. So, if you like this sort of volatility talk, this is how basically Option Pit does most of its teaching. All right? So special offer for all you guys and girls that are in the room. All right? Trading credit and debit spreads, right? You get to listen to Mark. Totally different delivery from me. Okay? It's $12. Sign up. I believe it's only available to this room today. Right? So it's helping you with buy-sell trade decisions, just like we discussed. Looking at credit and debit spreads and seeing what you're actually getting for them. Is it even worth doing the spread? Right? And trying to get a little more dollars out of the trade. Meaning, is the put spread giving me more than the call spread? Does Nigerian cover what you discussed? I don't know what John covers. I actually used to trade with I would trade with John on the CBOE, and his brother broke into my pit on the CBOE. Pretty funny, huh? Pete was just out of football. It was kind of funny back then. He was huge. We couldn't even haze him. He was too big. So I don't know what John teaches in his stuff. I have no idea. Okay. And basically looking for things that are interesting. No, I think this class is, this is a 1 hour class. There is some adjusting. This is available just to download. Okay? So there's no date, you just download it for $12. All right? And again, if you took the class, you took the credit and debit spread, and you want to try our chat room out or anything like that, let us know. Okay? There will be a recording of this talk, and you will be able to get it from Candlestick Trading Forum. Does anyone offer one-on-one coaching sessions to mentor? We do. Yes, we do. That's what we call our Platinum Series. The video should be 1 hour and 15 minutes. Okay. All right, everybody. Thank you very much. Oh, hello, Dion. The info from the Platinum Series is on our website. Better than usual. If you go to optionpit.com, /mentoring. Why are the pros focused on trading volatility? That's an awesome question. You know why? Because it reverts. Okay? Like I said, vol doesn't say cheap forever. It doesn't say expensive forever. Okay? All right, guys. Have a good day. And I think, Stephen, we're done. Where are the vol curves? Next session. You guys go to this link, Option Income, and you can sign up for this talk from Mark. And there, I believe the information is right there from Becky, optionpit.com/income. How do you trade the Greeks? We're having our boot camp class in a month. But that is a lot more than I can tell you right now because I got like 3 seconds. I'm Mark's partner at optionpit.com. Do we ever have open houses? Don, if you just write me a note at andrew@optionpit.com, we'll give you an open house for a couple of weeks. Okay? Say you saw us in, Candlestick, and send me a note, andrew@optionpit.com. Mark will talk some adjustments about this. Not huge. Okay? Who is Mark? Mark's the handsome guy that's always on TV. I'm always the guy in our chat room. No problem. Mark Sebastian. I'm Andrew Giovinazzi. This is recorded and will be available from Steve. Located out of Chicago. I live in Maine, though. Almost everything I do, though, is online. That was funny. All right, guys. Have a good day. Steven, I think we're done. No problem. I guess I'm just going to stop my desktop sharing.